Hello friends, behavioral science is all about gauging, understanding and being able to predict human behavior and actions for financial decisions based on their rational study and pre-understood patterns. Now, behavioral technical analysis is all about behavioral science rolled into technical analysis patterns infused into one. Now, I had promised you I would record a video in detail about counter-cyclical and pro-cyclical markets, what they are, how to identify which phase is going on, how to survive and more importantly thrive in these phases. And this video is all about in great detail how you can exercise your mind to make higher profits. For those of you who find my videos long, this video is kind of divided into multiple chapters. If you click on more below this video in the description, you will find the list of chapters. Feel free to watch each chapter at leisure. Split this video into a week, 2 week, 3 week time frame, whatever as time suits you, and break it into parts and assimilate and kind of understand the logic behind it. Now, in this video, I'm sharing with you knowledge that I have gained over the years, and I was a consulting trainer at the Multi-Commodity Exchange after 2005 up to 2009. And when I wrote the country's first commodity trading guide, which you can see here, it is still the only guidebook on commodities to be accepted and sponsored by the NCDX as a guidebook and a SY-BCom approved referral guide by Mumbai University since academic year 2017. So let's dive right in and what this video is all about. Now, the following are the points that I will discuss in this video. The definition of pro and counter cyclical markets, which is easier to trade out of the two, what is the most difficult phase to navigate in the pro-cyclical and counter-cyclical markets, identifying the unique features of counter-cyclical markets, identifying the unique features of pro-cyclical markets, which tools work best for a trader, a real-world trader in each phase, and position sizing in pro and counter-cyclical markets, and the role of social media for a trader in pro and counter-cyclical markets. So I begin with the first chapter itself, the definition of pro and counter-cyclical markets. It's pretty simple. The economic data could be pointing something and the market could be going in the opposite direction. The fact is that the data could be extremely positive and the market could be falling, or the data could be extremely negative but the market could be rising. Now, most of the traders who are active today in the market have come after the COVID-based lockdowns were imposed in March, April 2020. So I'll quote the recent past, because the human mind is hardwired towards the recency bias. You tend to remember the most recent events in your life faster than your distant past events, which is what is responsible in the function for the prefrontal cortex of the brain, right behind your forehead. Markets were rising, defying gravity, even though factories were shut, offices were shut, and people were locked at home. So commercial activity was not happening, but yet the markets went on zooming. That is an extremely relevant example of counter-cyclical markets. Remember, the very first counter tells you opposite. Now, what happens in pro-cyclical markets? In pro-cyclical markets, the economic activity could be going this way, the market will follow it. If the economic activity is going this way, the market will follow it. So there is complete harmony between the data points and the financial asset prices. Now, those of you who understand trading, and I completely respect real-world traders. I think a guy who's driving an auto rickshaw with his mobile phone tied with a thick rubber band onto his handlebars and looking at stock prices. Not that I support this activity, it's extremely dangerous. But this guy is an actual doer of deeds. Compared to the guy who's a non-participant, this auto rickshaw wala is actually what constitutes what we know as the market. No matter how small an influence he has in the market, he exerts it. All right. So the market is a study. Behavioral finance is a study of all these small and big traders and how prices will behave during counter and pro-cyclical phases. Now, in pro-cyclical phases, since the market is going to follow economic data, obviously more logical and more mathematical minded traders will make money. More in another chapter. Now, the second chapter, which market is more easier to trade? Well, counter-cyclical markets are irrationally emotional. Do remember, facts could be telling you one thing and the market could be going extremely divergent to the facts. COVID lockdown. Factories are shut, market is going up. Remember what happened in 2009, 2008, the global financial crisis was discovered and the US Fed started printing money, they started quantitative easing, they started supporting the markets, but markets would refuse to react to positive news no matter what would happen. That was another example of counter-cyclical markets. So economic data is going one way, the markets are going another. Emotional people are ruling the roost. And emotions don't need PhD degrees. It is mathematics and statistical model players or behavioral finance model players who have to be rational. So easier to trade, counter-cyclical markets are easier to trade because madness and emotions can outlive common sense, which is why phases of counter-cyclicality tend to be longer lasting and therefore more relatively simpler to trade. Of course, volatility is much higher because it is the retail guys playing on emotions and being completely knee-jerk and patchy where price discovery mechanism is concerned. Chapter number 3, which is the most challenging phase to trade in pro and counter-cyclical markets. Now let me tell you one thing very clearly, and this should lay to rest all your fears. When I have been warning you on social media, including my television, including my YouTube videos, social media posts and Telegram posts that counter-cyclical markets will end and pro-cyclical markets will start in 2025, I'm not saying that there will be a crash. All I'm saying is that the texture, the tone and tenor of the market will change completely. Why will the markets fall or the volatility will rise is very simple. Every time the market goes from one phase to the other. Now, whether counter-cyclicality is going to be replaced like pro-cyclicality, which I expect in 2025, or pro-cyclicality is being replaced by counter-cyclicality, the process is never smooth. The reason is, like I told you, the prefrontal cortex of the brain is used to recency bias. So far, for 4.5 years, retail traders have bought and then sold, which means go long, book profit. It's not sell and then buy, means go short and book profit at lower levels. So long positions have always given them money. They know only how to buy and they've started feeling that markets can only go up and going long is the only game in town. They will continue to do that when pro-cyclicality sets in. And the markets will thrash them about a lot. There will be a whole lot of volatility as shares change hands from weak to strong and strong to weak. So this is the most challenging and difficult phase in pro and counter cyclicality markets. It's not the phase itself which is challenging. It is the transition when the markets go from one phase to the other. That is where the biggest number of the graves of traders are dug. Transition. That is the most difficult. Now, your job is to understand that a transition is coming, take adequate safety measures and see to it that you don't bleed out to death and therefore have enough capital left to trade the next phase of the market whenever it sets in. That is the name of the game. So statistical beta or pure price volatility is the highest in the transition period, and once the transition period ends, market beta tends to settle down. People tend to get into the groove and start to adapt. We as Indians have a bigger nose for profits as compared to an average Western trading counterpart. We handle money better. We've been taught how to handle money thousands of years ago. So we tend to cope up better, which is the one good news. Whenever the transition occurs, we may be shaken up a little bit initially, but we will get up and start running faster than others, which is why the period of pain will be smaller. Now, what is crucial is that you lose as little capital in the transition phase, if at all you have to lose. If you're prepared, you might actually wind up making money when the jitters of the market occur in the transition phase. For example, I have been sharing with you MWPL data ahead of the election results which came out on 4th of June. I told you which counters had the heaviest MWPL and therefore the most vulnerable to crowded exits. And did you notice that many of these PSU counters, other private sector counters, which had very high buildup of MWPL over the last 90 days before the election results, actually fell the most, right? So you could actually profit from it if you were to create positions and dig your heels in before the pro-cyclicality phase begins and the transition jitters or the transition high beta spikes. This is called beta clustering. When a lot of volatility comes together and sticks together like glue, the markets are thrashing about every day, and every day is as painful as the previous one, and you can bet that the coming session will be as painful as the earlier one. So volatility will cluster together and you could actually wind up making progressively higher profits on your position that you have initiated in anticipation. But if you can't make money in the transition, see to it that you lose as little as possible so that you have enough ammunition to go all guns firing when the next phase begins. The trick to winning in the markets and being a successful trader is to lose less money than the next guy during drawdowns and to make more money than the next guy during profitable periods. It's as simple as that. Now, I will list out the salient features of counter-cyclical markets in this chapter. First of all, this market is not rational. The economy is going one way, financial asset prices are divergent from it. So emotions are ruling high, emotions are irrational, and therefore irrationality is what is ruling the roost. Statistical beta or pure price volatility is extremely high, and you will see price changing very erratically and in patches. You will have spurts of prices because traders are getting emotional, they're getting supercharged. Many a times traders are saying, hey, I haven't traded for the last 2 hours, 2 days, 2 weeks, let me do something. They notice a blip on the price, they rush in, they create clusters of volatility. How will you know? You will know it on your snapshot window when there will be a burst of prices. You will know on this tick by tick window, and I have marked with arrows as to how price is spurting with sudden changes in volumes. Now, this is a classic sign of counter-cyclical markets. Very, very agitated, emotional, impatient, frustrated traders. Believe me when I tell you this, you have ample tools on your trading terminal, a desktop full-featured trading terminal, to become a hero in trading. And on your mobile phone, you have somewhat of trading tools to be a somewhat reasonably successful trader because of the studies that many of the brokers have given you on your mobile apps. It's just that you haven't understood all the features that are at your command and you haven't used them well. So counter-cyclical markets will definitely give you enough warning shots. Hey, I'm here. Sit up and take notice. Spreads will be wider on the snapshot window and your spread quadrant will provide more challenges. Now, horizontal spreads. The bid and offer prices between buyers and sellers will be wide, which means you will take home less money because of the extreme greed and nervousness. The difference between the first, second, third, fourth, and fifth buyer and 1 to 5 seller will also be large because the financer knows that retail traders are greedy and he's quoting a wider and wider quote so as to take more money from you. Remember, the wider the quotes are, the smaller is your take home profit. So this is another classic sign. Please, for God's sake, for the sake of your family, learn screen reading. Cost of carry, which is financing cost, is invariably higher during counter-cyclical phases because the financer knows that an emotional trader wants to get rich quick. He wants to buy a car. He has dreams of taking his family to an overseas holiday. He wants to buy gold for his wife or a house for his family or whatever it is that you aspire for. And you will readily pay higher interest costs, badla charges, cost of carry, or contango. Call it in any language, it is nothing but financing cost and the cost that you're paying to the money lender. Now, this is a problem. Now, I have been telling you about MWPL, Market Wide Position Limits. In my humble opinion, it is one of the most crucial indicators that you need to monitor. You will notice MWPL behave in a very, very typical manner in a counter-cyclical market. There will be a routine fall on expiry because not everyone rolls over all their trades on expiry. So every 4 weeks, MWPL falls like you're seeing on the chart. And then there is a recovery for the next 3.5 weeks. Why 3.5 weeks? Because by Monday or Tuesday of the expiry week, MWPL peaks out, starts going sideways, and then falls again on the expiring Thursday. Now, what happens in counter-cyclical markets is A, the MWPL may or may not fall as low as the prior month. But what will happen is post-expiry, MWPL will rise much, much more faster. What's happening? The markets are talking to you. I just told you the numbers talk to you. The markets are telling you, guys are getting greedy. They are coming back and initiating more and more trades, expecting to get rich quick. They are in a hurry to make a lot of money. And believe me, this is where mistakes are made. So you will see a lot of MWPL spikes very, very fast, especially in those counters where prices have been more volatile than the others. By the way, MWPL has risen very sharply post-expiry in August 2024 as I record this video. The tick by tick window I already told you about. I repeat it, here it is. You will see very sporadic bursts in prices and very huge volumes rather than a continuous stream of price volume open interest. You will see sporadic bursts. This is the retail guys getting caught. Now, I have never fully understood why the retail guy behaves the way he does, but then hey, he is the retail guy. He suddenly sees a big spurt in volume or in price. He jumps in. He wants to get rich quick. And then what happens? The price frustrates him. For the next 20-30 minutes, it doesn't go anywhere. It goes against him. Retail guys invariably tend to go long. They don't know how to go short more often than not. So they jump in because they saw a big spurt in price and open interest and volume, only to see the price is slowly but surely sliding down, especially during lunchtime. I have recorded enough videos as to tell you which is a good time to trade, which hour of the day is good enough to trade, and please watch that video. As a matter of fact, all the videos that I want you to watch are in the description below this video and in the pinned comment below this video. If you want to be a successful trader, I would suggest you watch these videos if you want to. So these traders with half-baked knowledge of screen reading jump in when they see sporadic bursts in prices, volumes, and open interest, only to get frustrated, get stopped out, exit the trade, create more sporadic bursts in volumes when their stop losses are hit. This is a classic sign of counter-cyclical markets. The other aspect of counter-cyclical market is that it's not just the financer who's extracting his pound of flesh from the retail guy. Also, non-market participating experts start to come and milk them. Now, they could be anybody. They could be people who are providing mentorship programs, advisory services, legal or illegal portfolio management services, selling software, selling algos, so-called algos, or the codes for the trading view indicators that they are formulated and whatnot. Now, before you start to throw acid at me through the comment section in this video, let me clarify my stand on the non-market participating experts. I think they are a very, very useful part of the market. Surprised? You should be. I find these non-market participating experts completely useful because they lead the retail trader into initiating trades in the market. Unfortunately, more often than not, the retail guy comes to get massacred. So that is undesirable. But the market is the market, and these guys, the non-market participating influencers, basically generate volumes. They create volumes, not by their own actions, but by the influence that they have over the people. So they provide counterparties to the market. Now, in this order-driven market, where the exchange is the platform and the buyer and the seller put in their quotes, as long as the prices match, there will be a transaction. So in an order-driven market, you need a counterparty. A buyer needs a seller who he can buy from, and a seller needs a buyer who he can sell to. So what these influencers are doing is providing liquidity and counterparty. Unfortunately, like I said, the retail guys don't really make too much money, but the bid and offer spreads narrow down when there is a lot of participation. Now, why do these retail guys continue to get influenced by this suboptimal quality advice? Because more often than not, the market continues to give you very tiny but somewhat frequent profits. Once in a while, it just gives you a punch, knocks the wind out of your lungs, and gives you a loss. You have to start the process all over again and start collecting pennies so that you can lose $1 after a week or 2 weeks. But human psychology is such that we tend to forget the painful aspect of the market, which is losses, and we tend to focus, like we've been trained, always think positive. So we count our profits and do not include the losses. A simple tally in Microsoft Excel of what your trading profits and losses are. I've explained to you in this video why you should maintain a trading log. All right. So when you do that, you will basically see as to what the realistic outcome is during counter-cyclical markets of this activity of listening to non-market participants. Some of the most illogical, irrational, and bizarre theories are floated in counter-cyclical markets, because do remember, counter-cyclicality means the market prices are moving away from economic reality. Now, what has happened in counter-cyclical markets that started in 2020 in April? We heard fairy tales of super cycles in oil and gas. Do I really need to share screenshots of the headings of media articles, social media platforms of prominent guys? I don't think that's required at all. At all. We are not here to rub people the wrong way. We are here to learn about how the markets function. So $200, $250, $300, sometimes even $350 targets of WTI crude were given between 2020 to 2023. Didn't happen. Natural gas, $10, $15, even $20, especially during the initial phases of the commencement of the Ukraine war. Now, these are theories that are propagated because the retail guy is illogical and ignorant enough to believe it. This can only happen in counter-cyclical markets. Let me give you a small example. I have been very vociferous about laughing at people who've been saying copper is going to be in a very short supply and the market is going to explode. Forget about copper. Let's go into aluminum. Aluminum fell from approximately 250 rupees a kilo to close to 205, 207 odd kilo per kilo on the MCX. That means that it is in a bear market. The Dow theory says anything that falls more than 20% is in a bear market. So is copper for that matter. But why am I so surprised about aluminium? If you just Google search or go to Wikipedia and search aluminium, you will be surprised and then you will do what I do at these super cycle theories. Ha ha ha, laugh. 8% of the Earth's crust is made up of aluminium. Most probably, you dig anywhere in any part of the world, barring of course the ocean, which is not commercially viable, and some parts of deserts, you will find aluminium everywhere. So when these non-participating experts come out and tell me, hey, aluminium is running out, it's going to go to 500 rupees a kilo, buy it at 250 bucks a kilo. The first thing I do is go to Daru Khana. Daru Khana does have nothing to do with alcohol. Daru Khana is Asia's largest scrap metals market. Now here are people, I told you, an auto rickshaw guy who trades markets has a better understanding of the markets than a guy who's sitting on the sidelines, doesn't trade, but he's dispensing knowledge. So in Daru Khana, you have third and fourth generation scrap dealers in metals who have done nothing all their lives but deal with metal scrap. And you will see A class, B class, D class, C class cars coming out, executives coming out in suits and ties and selling them tons and tons of metal filings from their plants run by listed companies. They've got their hair white or gone bald in this business for 4 generations. I go and ask them, what do you think of metal? I'm hearing reports about aluminium going to 500. Sure enough, we have a good laugh together. So stick to people who are in the business. Counter-cyclicality can actually give you hopium. Hope is the most dangerous thing in financial markets. Stick to facts. Facts don't lie. Now, features of pro-cyclical markets. We talked about counter. Now it's time for pro-cyclical markets. Now, the fact that pro-cyclical market goes with the economic data means it's a lot more rational, lot more logical, and this phase is something where traders continue to make good profits provided they have knowledge of the markets that they are trading in. So they know what will impact the price, they look at those factors continuously, and they monitor even the ancillary examples and ancillary data points that will influence the market. In short, if you were to tell me, hey Vijay, tell me in brief, let's not go into excessive detail. In short, this is a market of the specialist, by the specialist, for the specialist.